Managing credit risk is extremely important for banks, non-banking finance companies and others players in the financial markets, and also for those organizations which are not in finance but extend credit such as trade credit to the customers. These are the 10 guidelines that they can follow in order to reduce their exposure and manage the credit risk. Limit the exposure that you take on a specific account or on a group such as an industrial group or to a specific geography, a specific product or a market. If the exposure required is very large for the bank's appetite, the banks can share the exposure with other banks, for example by acting as a lead syndicator bank and then pulling in other banks to take the exposure and share the risk. The bank should match the rate sensitive assets with the rate sensitive liabilities, what is called matching of RSAs with RSLs. The bank should have a proper asset and liability management in place and should have the sales and commissions of their business development people aligned well with the risk management strategy. The bank should make sure that they are diversifying their portfolio in order to reduce the concentration risk. The diversification brings in covariance, which is the relationship between different accounts, and then therefore the banks can attain an optimum profile where the risk is minimized and the opportunity or the profit is maximized. The bank should measure the risk from time to time using measurements such as the probability of default, exposure at default, loss given default, the gross NPAs, the net NPAs, the value at risk, the duration of the credit exposure and the convexity of the credit exposure. The bank should make sure that they have the appropriate pricing model in place to make sure that the pricing or the interest rate which is charged to the customer is in line with the risk in the specific borrower account. The appropriate pricing will make sure that the bank is not just able to grow but is able to attract right kind of customers, reduce their NPAs and also manage their profitability. Appropriate pricing will make sure that the bank has the optimum risk return profile of its portfolio. The bank should make use of appropriate derivative products such as the asset-backed securities, the mortgage-backed securities, interest rate swaps as well as the forward rate agreements in order to manage the risk in its portfolio. Additionally, the bank can insure itself against any kind of default by using derivative products like the credit default swaps or total return swaps, and in addition they can obtain the guarantees of other bankers or other players for the loans that they are extending. The bank should maintain a good database of their customers and make sure that they analyze the data appropriately using the appropriate technology to take care that their decisions are in alignment with their risk management strategy. The bank should make sure that they are deploying the latest technologies such as the machine learning and artificial intelligence as well as business process management technology.